In Chapter 8, we will cover audit planning in detail, gain an understanding of the client's business and industry, develop an overall audit plan and strategy, and making a preliminary judgment about materiality. At the end of Chapter 8, you should be able to do the following. You should be able to discuss why adequate audit planning is essential, make client acceptance decisions and perform initial audit planning, gain an understanding of the client's business and industry, perform preliminary analytical procedures, apply the concept of materiality to the audit, make a preliminary judgment about what amounts to consider material, determine performance materiality during audit planning, and use materiality to evaluate audit findings. We will begin by discussing why adequate audit planning is essential. The principles underlying the AICPA auditing standards indicate that the auditor must plan the audit and properly supervise any assistance. There are three main reasons why the auditor should properly plan the audit engagement. First is to enable the auditor to obtain sufficient appropriate evidence for the circumstances to help keep audit costs reasonable and to avoid misunderstandings with the client. Obtaining sufficient appropriate evidence is essential if the CPA firm is to minimize legal liability and maintain a good reputation in the business community. Keeping costs reasonable helps the firm remain competitive. Avoiding misunderstandings with the client is necessary for maintaining good client relations and for facilitating high-quality work at reasonable costs. In here we have the 8 major parts of planning an audit. Each of the first 7 parts is intended to help the auditor develop the last part, which is to have an effective and efficient overall audit plan and audit program. The first 4 parts of the planning phase of an audit will be covered in this chapter. This will be accepting client and performing initial audit planning, understanding the client's business and industry, performing preliminary analytical procedures, and setting preliminary judgment of materiality and performance materiality. The last 4, as seen in this figure, will be covered separately in later chapters. Please do read Figure 8-1, which you can find on page 221 of your textbook. Before beginning our discussion on planning, let us first discuss the 3 risk terms relevant to audit planning, which are acceptable audit risk, client business risk, and the risk of material misstatement. Acceptable audit risk is a measure of how willing the auditor is to accept that the financial statements may be materially misstated after the audit is completed and an unmodified opinion has been issued. When the auditor decides on a lower acceptable audit risk, it means that the auditor wants to be more certain that the financial statements are not materially misstated. 0 acceptable audit risk is equivalent to certainty, and 100% risk is complete uncertainty. In contrast, client business risk is the risk that the entity fails to achieve its objectives or to execute its strategies. Business risk can arise from factors such as significant changes in industry conditions or events such as regulatory changes, or from the setting of inappropriate objectives or strategies. The risk of material misstatement is the risk that the financial statements will contain a material misstatement due to fraud or error prior to the audit. The risk of material misstatement is a function of the susceptibility of the financial statement as a whole or in individual accounts to misstatement, and the effectiveness of the client's controls in preventing or detecting and correcting the misstatements. Assessing acceptable audit risk, client business risk, and the risk of material misstatement is an important part of audit planning because it helps determine the audit procedures and amount of evidence that is needed to be accumulated, as well as the experience level of staff needed for the audit engagement. Moving on, we will now discuss the first major part of audit planning, which is to accept a client and perform initial audit planning. Initial audit planning involves 4 things, all of which should be done early in the audit. First, the auditor decides whether to accept a new client or to continue serving an existing client. Then the auditor identifies why the client wants or needs an audit, followed by the auditor obtaining an understanding with the client about the terms of the engagement to avoid any misunderstanding related to the performance of the audit. And lastly, the auditor develops the overall strategy for the audit, including engagement staffing and any required audit specialists. An auditor is unlikely to accept a new client or to continue serving an existing client if the risk associated with the client is greater than the risk that the firm is willing to accept. Before accepting a new client, most CPA firms investigate the company to determine if its acceptability is within the client's risk tolerance. They do this by examining to the extent possible the prospective client's standing in the business community, the financial stability and relation of the client with its previous CPA firm. For prospective clients that have been previously audited by another CPA firm, the new auditor is required by auditing standards to communicate with the predecessor auditor. The purpose of the requirement is to help the new auditor evaluate whether to accept the engagement. The communication may, for example, inform the new auditor that the client lacks integrity or that there have been disputes over accounting principles, audit procedures, or the audit fees. However, the confidentiality requirements in the Code of Professional Conduct requires that the old auditor obtain permission from the client before the communication can be made with the new auditor. AICPA auditing standards also require that the auditors determine whether the financial reporting framework to be used by management to prepare the financial statement is appropriate. Without an appropriate financial reporting framework, the auditor does not have suitable criteria for auditing the financial statements. In making that determination, the auditor considers the nature of the entity, the purpose and nature of the financial statements, and whether laws or regulations prescribe a particular framework for that client. For existing clients, Many CPA firms evaluate existing clients annually to determine whether there are reasons for continuing to do the audit. Previous conflicts over the appropriate scope of the audit, the type of opinion to issue, unpaid fees, or other matters may cause the auditor to discontinue association with the client. The auditor may also drop a client after determining the client lacks integrity. Even if none of the previously discussed conditions exist, the CPA firm may still decide not to continue doing audits for a client because of excessive risk. Investigating new clients and re-evaluating existing ones is an essential part of deciding acceptable audit risk. Two major factors affecting acceptable audit risk are the likely statement users and their intended uses of the financial statements. A clear understanding of the terms of the engagement should exist between the auditor and the client. Auditing standards require that the auditors obtain an understanding with the client in an engagement letter, which includes the engagement's objectives, the responsibilities of the auditor and management, identification of the financial reporting framework used by management, reference to the expected form and content of the audit report, and the engagement's limitations. An engagement letter information is important in planning the audit because it affects the timing of the test and the total amount of time the audit and other services will take. An example of an engagement letter is presented in Figure 8-2 on page 225 of your textbook. After understanding the client's reason for an audit, the auditor should develop and document a preliminary audit strategy that sets the scope, timing, and direction of the audit, and that guides the development of the audit plan. The planned audit strategy helps the auditor determine the resources required for the audit, including engagement audit staffing. The CPA firm must assign the appropriate staff for the engagement to comply with auditing standards. The auditing standards require that auditors assigned to an audit must have appropriate competence and capabilities to perform the audit. Auditors assigned to the engagement must also be knowledgeable about the client's industry. If the audit requires specialized knowledge, it may be necessary for the CPA firm to consult a specialist. The auditing standards establish requirements for selecting specialists and reviewing their work. As mentioned previously in our discussion, a thorough understanding of the client's business and industry and the knowledge about the company's operations are essential for the auditor to conduct an adequate audit. In the next few slides, we will discuss how the auditor gains an understanding of the client's business and industry. Auditing standards require the auditor to perform risk assessment procedures to obtain an understanding of the client's business and its environment, to assess the risk of material misstatement in the financial statements, including inquiries of management and the use of analytical procedures. Several factors have increased the importance of understanding the client's business and the industry, such as the recent significant declines in economic conditions around the world that may impact the client's business and operations. Information technology that connects the client's companies with major customers and suppliers that exposes the clients to potential risks. The client has expanded operations globally through joint ventures or strategic alliances. Information technology that affects internal client processes, improving the quality and timeliness of accounting information. The increased importance of human capital and other tangible assets has increased accounting complexity and the importance of management judgments and estimates. And lastly, the client investing in complex financial instruments which may have declined in value would require complex accounting treatments and often involve unknown counterparties who may create unexpected financial risk to the client. In here, we have an overview of the strategic approach to understanding the client's business and industry. We will discuss several aspects of this approach, and you can find figure 8-3 on page 227 of your textbook. The three primary reasons for obtaining a good understanding of the client's industry and external environment are: the risks associated with specific industries may affect the auditor's assessment of client business risks and acceptable audit risks. Many risks are common to all clients in certain industries. Familiarity with those risks aids the auditor in determining their relevance to the client when assessing client business risks and the risk of material misstatement. And lastly, many industries have unique accounting requirements that the auditor must understand to evaluate whether the client's financial statements are in accordance with accounting standards. The auditor should understand factors such as major sources of revenue, key customers and suppliers, sources of financing, and information about related parties that may increase the client's business risk. A tour of the client's facilities is helpful in obtaining a better understanding of the client's business operations because it provides an opportunity to the auditor to observe operations firsthand and to meet key personnel. Transactions with related parties are important to auditors because accounting standards require that they be disclosed in the financial statements if they are material. A related party is defined in auditing standards as an affiliated company, a principal owner of the client company, or any other party with which the client deals, where one of the parties can influence the management or operating policies of the other. In contrast, a related party transaction is any transaction between the client and a related party. A transaction with a related party is not an arm's length transaction. Therefore, there is a risk that they may not be valued at the same amount as a transaction with an independent third party. Because management establishes a company's strategies and business processes, an auditor should assess management's philosophy and operating style and its ability to identify and respond to risks, as this significantly influences the risk of material misstatements in the financial statements. A firm's governance includes its organizational structure as well as the activities of the board of directors and the audit committee. To gain an understanding of the client's governance system, the auditor should understand how the board and the audit committee exercises its oversight, including consideration of the company's code of ethics and the evaluation of the corporate minutes. Companies frequently communicate the entity's values and ethical standards through policy statements and codes of conduct. The Security Exchange Commission requires each public company to disclose whether it has adopted a code of ethics that applies to senior management, including the CEO or CFO and principal accounting officer or controller of the company. The auditor should gain knowledge of the company's code of ethics and examine any changes and waivers of the code of conduct that have implication about the governance system and related integrity and ethical values of senior management. The corporate minutes are the official record of the meetings of the board of directors and shareholders. They include key authorizations and summaries of important topics discussed at these meetings and the decisions made by directors and shareholders. The auditor should read the minutes to identify matters relevant to the audit. Strategies are approaches followed by the entity to achieve its organizational objectives. The auditor should understand the client's objectives related to reliability of financial reporting, the effectiveness and efficiency of operations, and compliance with laws and regulations. Despite management's best efforts, business risks arise that threaten management's ability to achieve its objectives. As a result, the knowledge of clients' objectives and strategies helps the auditor to assess the client's business risks and the risk of misstatements in the financial statements. A client's performance measurement system includes key performance indicators that management uses to evaluate progress toward its objectives. Such key performance indicators may include market share, sales per employee, unit sales growth, unique visitors to a website, same-store sales, and sales per square foot. Inherent risk of financial statement misstatements may be increased if the client has set unreasonable objectives or if the performance measurement system encourages aggressive accounting. Performance measurement includes ratio analysis and benchmarking against key competitors. As part of understanding the client's business, the auditor should perform ratio analysis or review the client's calculations of key performance ratios. We will be discussing next the third step in the planning process, which is the performance of the preliminary analytical procedures. As noted in Chapter 7, auditors are required to perform preliminary analytical procedures as part of the risk assessment procedures to better understand the client's business and industry and to assess the client's business risk. One such procedure compares the client ratios to industry or competitor benchmarks to provide an indication of the company's performance. Such preliminary tests can reveal unusual changes in ratios compared to prior years or to industry averages and help the auditor identify areas with increased risk of misstatements that might require further attention during the audit. Auditors often prepare common-size financial statements for one or more years that display all items as a percent of a common base. Common-size financial statements allow for comparison between companies or for the same company over different time periods, revealing trends and providing insight into how different companies compare. This is illustrated in Figure 8-4 on page 233 of your textbook. In here, we have an illustration of the use of preliminary analytical procedures as part of the audit planning process. It presents the key financial ratios for Hillsburg Hardware Company, along with comparative industry information that auditors might consider during the audit planning. These ratios are based on the company's financial statements, which you can find on the glossy insert after page 168 of your textbook. The company in this particular example is a niche provider in the overall hardware industry, which is dominated by national chains. The auditor identified potential increase in competition from national chains as a specific client business risk for its customers. Increased competition could affect sales and profitability for the company's customers, likely affecting the company's own sales and the value of assets such as accounts receivable and inventory. An auditor might use ratio information to identify areas where the company faces increased risk of material misstatements. In this illustration, the profitability measures indicate that the company is performing fairly well despite the increased competition from larger national chains. Although lower than the industry average, the liquidity measures indicate that the company is in good financial condition, and the leverage ratios indicate additional borrowing capacity. Because the company's market consists of smaller independent hardware stores, the company holds more inventory and takes longer to collect receivables than the industry average. In identifying areas of specific risk, the auditor in this particular example is likely to focus on the liquidity activity ratios. Inventory turnover has improved but is still lower than the industry average for this particular company. Accounts receivable turnover has declined slightly and is lower than the industry average. The collectibility of accounts receivable and the inventory obsolescence are likely to be assessed as having higher risk of material misstatement and will therefore likely warrant additional attention in the current year's audit. Do keep in mind that numerous potential comparisons of current and prior period data extend beyond those normally available from industry data. You can find Table 8-1 on page 232 of your textbook. The next topic we will cover is the concept of materiality to the audit. After performing preliminary analytical procedures, the fourth step in the audit planning process is to make a preliminary judgment about materiality for the audit of the financial statements. Auditing standards define materiality as the magnitude of misstatements that individually or when aggregated with other misstatements could reasonably be expected to influence the economic decision of users made on the basis of the financial statements. The auditors follow 5 closely related steps in applying materiality. The auditor first determines materiality for the financial statements as a whole. Second, the auditor determines performance materiality which is materiality for segments of the audit as shown in the first bracket of figure 8-5. Segments of the audits could be classes of transactions, account balances, or disclosures. We discussed segments of the audits in detail on previous chapters. The first two steps, which are part of planning, will be the primary focus for the discussion of materiality in this chapter. Step 3 occurs throughout the engagement when auditors estimate the amount of misstatements in each segment as they evaluate audit evidence. Near the end of the audit, during the engagement completion phase, the auditors proceed through the final two steps. These latter three steps, as shown in the second bracket in this figure, are part of evaluating the results of audit tests. Auditing standards require auditors to decide on the combined amount of misstatements in the financial statement that they would consider material early in the audit. This is referred to as the preliminary judgment about materiality. Step 1 in the application of materiality on figure 8-5, the preliminary judgment about materiality for the financial statement as a whole, is the maximum amount by which the auditor believes the financial statements could be misstated and still not affect the decisions of reasonable users. The auditor set a preliminary judgment about materiality to help plan the appropriate evidence to accumulate during the audit. The lower the dollar amount of the preliminary judgment, the more audit evidence is required. During the audit, auditors may change the preliminary judgment about materiality. This is referred to as the revised judgment about materiality. Auditors are likely to make the revision because of changes in one of the factors used to determine the preliminary judgment. For example, client circumstances may have changed due to qualitative events such as the issuance of debt, which created a new class of financial statement users. Please read figure 8-5, which you can find on page 235 of your textbook. Moving on, we will now discuss the factors affecting preliminary materiality judgment. Several factors affect the auditor's preliminary materiality judgment for a given set of financial statements. The most important ones are materiality is a relative rather than an absolute concept. Benchmarks are needed for evaluating materiality, and qualitative factors also affect materiality. Accounting and auditing standards do not provide specific materiality guidelines to audit practitioners. The concern is that such guidelines might be applied without considering all the complexities that should affect the auditor's final decision. However, in your textbook, illustrative guidelines are shown in figure 8-6 in the form of policy guidelines of a certified public accounting firm. The illustration on figure 8-6 is only intended to help students understand the concept of applying materiality in practice. In here, we have an example of an illustrative materiality guideline. You will notice that the guidelines in an illustration are formulas using one or more benchmarks and a range of percentages. The application of guidelines such as the one in here requires considerable professional judgment. Using the illustrative guidelines in this figure, Let us examine a preliminary judgment about materiality for a company. The guidelines are specified in 1, 2, and 3 of the illustration. If the auditor decides that the general guidelines in this example are reasonable, the first step is to evaluate whether any qualitative factors significantly affecting the materiality judgment could be identified. Assuming no qualitative factors exist, if the auditor concludes at the end of the audit that combined misstatements of operating income before taxes are less than 3%, the financial statements will be considered fairly stated. If the combined misstatements exceed 6%, the financial statement will not be considered fairly stated. If the misstatements are between 3 to 6%, a more careful consideration of all facts will be required. The auditor in this particular example then applies the same process to all the other bases being used in the audit. You can find figure 8-6 on page 238 of your textbook. We will now discuss performance materiality during audit planning. Step 2 in applying materiality is the determination of performance materiality. Performance materiality is defined as the amount set by the auditor at less than materiality for the financial statement as a whole to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceeds materiality for the financial statements as a whole. Many auditors set performance materiality for most tests as a standard percentage of the preliminary judgment about materiality for the financial statement as a whole. Performance materiality is often set at 50 to 75% of overall materiality. However, performance materiality can vary for different classes of transactions, account balances, or disclosures, especially if there is a focus on a particular area. The process of determining performance materiality is referred to as the allocation of the preliminary judgment about materiality to segments. The determination of performance materiality is based on professional judgment and reflects the amount of misstatement an auditor is willing to accept in a particular segment. The Public Company Accounting Oversight Board refers to the performance materiality amount as the tolerable misstatement, whereas the AICPA standards define tolerable misstatement as the application of performance materiality to a particular sampling procedure. Auditors face three major difficulties in allocating materiality to balance sheet accounts. These major difficulties are: first, the auditors expect certain accounts to have more misstatements than others. Second, both overstatements and understatements must be considered. And lastly, relative audit costs affect the allocation. It is worth keeping in mind that at the end of the audit, the auditor must combine all actual and estimated misstatements and compare them to the preliminary judgment about materiality. In determining performance materiality levels, the auditor is attempting to do the audit as efficiently as possible. In here, we have an illustration of the allocation approach used to establish different performance materiality levels across segments of the financial statements for the audit of Hillsburg Hardware Company. It summarizes the balance sheet, combining certain accounts, and shows the allocation of total materiality of $442,000, which is 6% of earnings from operations. The allocation approach in this example uses judgment in the allocation, subject to two arbitrary requirements by the auditor, which were the first requirement being that performance materiality for any account in this example cannot exceed 60% of the preliminary judgment of $265,000. Preliminary judgment in this example was set at $442,000. The second requirement is the sum of all performance materiality levels cannot exceed twice the preliminary judgment about materiality of $884,000. Notice in the allocation that the auditor is concerned about the combined effect on operating income of the misstatement of each balance sheet account. An overstatement of an asset account will therefore have the same effect on the income statement as an understatement of a liability account. In contrast, a misclassification in the balance sheet, such as a classification of a notes payable as an accounts payable, will have no effect on the operating income. Therefore, the materiality of items not affecting the income statement must be considered separately. Figure 8-7 also includes the rationale followed in deciding performance materiality for each account. For example, a small amount of performance materiality was assigned to notes payable, even though it is as large as inventory. If $132,500 had been assigned to each of those two accounts, more evidence would have been required in inventory, but the confirmation of the balances in notes payable would still have been necessary. It was therefore more efficient on the part of the auditor to allocate $265,000 to inventory and a small amount to notes payable. In summary, the purpose of allocating the preliminary judgment about materiality to balance sheet accounts is to help the auditor decide the appropriate evidence to accumulate for each account on both the balance sheet and income statement. Regardless of how the allocation is done, when the audit is completed, the auditor must be confident that the combined misstatements in all accounts are less than or equal to the preliminary or revised judgment about materiality. You can find figure 8-7 on page 240 of your textbook. The first two steps in applying materiality involve planning, which we just discussed. The last three steps result from performing audit tests. We will cover in our discussion in the next few slides an introduction on the use of materiality to evaluate audit findings. More details will be covered in subsequent chapter discussions. When auditors perform audit procedures for each segment of the audit, they document all misstatements found. Misstatements in an account can be of two types, which are known misstatements or likely misstatements. Known misstatements are those where the auditor can determine the amount of misstatement in the account. There are two types of likely misstatements. The first are misstatements that arise from the differences between management's and the auditor's judgment about estimates of account balances. The second are projections of misstatements based on the auditor's test of a sample from a population. In here, we have an illustration of the last three steps in applying materiality. For simplicity, only three accounts are included. The misstatement in cash of 2,000 is a known misstatement due to unrecorded bank service charges detected by the auditor. Unlike for cash, the misstatements for accounts receivable and inventory are based on a sample. The auditor calculates likely misstatements for this particular example in accounts receivable and inventory using known misstatements. The allowance for sampling risk results because the auditor has sampled only a portion of the population, and there is a risk that the sample does not accurately represent the population. We will discuss sampling risk in more detail in Chapter 15 and 17. In combining misstatements in Table 8-2, we can observe that the known misstatements and direct projection of likely misstatements for the three accounts adds to 45,500. However, the total allowance for sampling risk is less than the sum of the individual sampling risk amounts. This is because the allowance for sampling risk represents the maximum misstatement in account details not audited. It is unlikely that this maximum misstatement amount exists in all accounts subjected to sampling. Table 8-2 shows that the total estimated likely misstatement of 62,300 exceeds the preliminary judgment about materiality of 50,000. The major area of difficulty in this particular example is inventory, where estimated misstatement, including allowance for sampling risk of 47,250, is significantly greater than performance materiality of 36,000. Because the estimated combined misstatement exceeds the preliminary judgment, the financial statements are not acceptable based on this example. The auditor can either determine whether the estimated likely misstatement actually exceeds 50,000 by performing additional audit procedures, or require the client to make an adjustment for estimated misstatements. If the auditor in this particular example decides to perform additional audit procedures, they will be concentrated in the inventory area for this audit. We have reached the end of the discussion for Chapter 8. In this chapter, we covered the four major parts of audit planning and the application of the concept of materiality to the audit. Please complete the required evaluation method for Chapter 8 as it will be part of your final grade. In lieu of quizzes and homework, there will be a comprehensive problem that needs to be submitted on the specified due date. Please use the comprehensive problem module in Blackboard for instruction and requirements. You have reached the end of the course presentation for Chapter 8. Please access the video for Chapter 9 for the next presentation of the course.